The numbers you see when you open your bank app right now are a mathematically engineered illusion. They sit there completely static, tricking your brain into thinking your wealth is safe. But a massive percentage of that purchasing power has already been marked for erasure. Just days ago, the Federal Reserve executed a silent policy maneuver that guarantees the sustained devaluation of the money in your pocket. And the vast majority of the population is entirely distracted by the political noise. Today, we are exposing the exact blueprint of this silent wealth transfer. Those who comprehend these mechanics are positioning themselves to multiply their net worth. Everyone else faces a mathematical wipeout. To understand the imminent collapse of your purchasing power, you must first understand the fundamental deception of modern money. It is the greatest magic trick ever pulled on the global population. The exact mechanism of this deception will be revealed shortly, but to see the trap, we have to look at the history of the ruler. Millennia ago, human labor was exchanged for tangible items, stones, shells, eventually gold. Gold became the ultimate standard because it required intense physical energy to extract. It could not be manifested out of thin air. It was a perfect, unchangeable ruler used to measure human time and energy, but gold was heavy and difficult to transport. The solution was the introduction of paper receipts, representing gold stored safely in vaults. Over decades, a systemic realization occurred within central banking authorities. If the population traded the paper instead of the physical gold, the paper could be printed infinitely without ever acquiring the corresponding metal. The tide of physical energy was severed. The ruler was suddenly adjustable. When the governing authority prints capital, the newly introduced currency dilutes the value of all existing currency. Your bank balance does not decrease in digits. It decreases in capacity. It is a hidden tax, extracted from you without legislation. An event just occurred that fundamentally altered the trajectory of global markets. Under the leadership of the newly appointed Federal Reserve Chairman, Kevin Warsh, the central bank faced a mathematical paradox. The expectation from the market and the demands from politicians was a massive reduction in interest rates to stimulate a strained economy. The reality delivered a shockwave. The committee voted unanimously to hold the federal funds rate at 3.50% to 3.75%. Simultaneously, the economic projections revealed a terrifying pivot. 9 out of 18 committee members signaled that rates would actually need to rise by the end of the year, completely erasing previous expectations of a rate cut. The reason? A severe acceleration in headline inflation, surging to 4.2%, driven by global energy shocks, oil volatility, and supply chain disruptions in the Middle East. The institution abandoned all forward guidance. They stopped warning the market what comes next. Chairman Warsh even suggested looking at trimmed mean inflation, a metric that literally cuts out the highest price increases to make the data look smoother. This era of strategic ambiguity signals a profound, undeniable reality. The system can no longer be gracefully managed. The inflation target of 2% has been abandoned in practice, even if they maintain it in their speeches. When inflation runs continuously above 4%, the mathematics of confiscation become brutal. It is not merely that goods become more expensive, it is that the currency itself is structurally melting. A society programmed to save fiat currency in traditional banking vehicles is a society walking blindly into a slow-motion default. If your savings yield fails to exceed the true rate of currency debasement, you are actively losing wealth every single second of the day. Yet, a specific demographic remains entirely insulated from this erasure. The ultra-wealthy do not fear inflation. In fact, they utilize it as an accelerant for wealth creation. The mechanics of this insulation are counterintuitive, but they form the ultimate defense mechanism against a hostile monetary policy. The blueprint relies on the complete abandonment of fiat currency as a store of value. Instead, currency is strictly treated as a medium of exchange, immediately converted into hard, scarce assets. Hard assets possess intrinsic scarcity. They cannot be manifested by a central bank committee voting in a room in Washington. When the Federal Reserve inevitably expands the monetary supply to cover national debt, the fiat denominator increases, which mechanically drives up the nominal price of scarce assets. Furthermore, the wealthy use strategic fixed-rate debt as a weapon. By locking in long-term debt to acquire these hard assets, the debtor is permitted to repay the obligation with future, deeply devalued dollars. The inflation literally erodes the true cost of the debt while inflating the value of the underlying asset. It is an asymmetric arbitrage against the collapse of the currency. This is exactly why the adoption of decentralized mathematically capped assets like Bitcoin is accelerating among institutions. It is an unshortenable ruler, but holding it on an exchange leaves you vulnerable to third-party risk. If you want to know exactly how I protect my hard assets, I use cold storage. The June 2026 Federal Reserve decisions were not merely technical adjustments, they were declarations. The era of cheap money and stable purchasing power has concluded. A critical divergence is currently underway. One portion of the population will continue to measure their wealth in a melting unit of account, watching their labor slowly confiscated by invisible mechanisms. The other portion will recognize the illusion, abandon the flawed ruler, and migrate their energy into unprintable, decentralized, and scarce ledgers of value. The wealth is not vanishing. It is merely migrating to those who understand the mathematics of the new system. The only remaining variable is which side of the equation you choose to occupy.